Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday. I'll be joined by members of the media, academia, and financial services as we analyze all the news this week in retirement markets, technology, personal finance, so much more. It's a new year with a lot of news, so sit back, relax, and enjoy this episode of BRN Sunday.
Let's kick things off with a look at technology. And joining us online, he's lead advisor and executive producer for Seven Investing. Let's welcome back to the program, Daniel Klein. Dan, great to see you. Happy New Year to you and your family. 2021, hope things are changed for the better.
Happy New Year, happy 4th of July, happy Halloween. I have no idea what day it is. They're all the same in Florida, made even worse by 2020. Happy to see this year go.
Yeah, let's hope we all can turn the page health-wise and professionally, personally, all those good things. So let's jump in, Dan, because, new year, but, 2020 really has been shaped by the virus and a lot of adaptability. And one thing you wanted to talk about was online delivery and how it has changed the way we've eaten.
Yeah, it's one of those strange things. So we went from, there was relatively little delivery availability. You could get pizza in most markets. There might be something else that delivered. Maybe you live someplace where there was a local delivery service. And really, in the last few years, we've had an absolute explosion with, Uber Eats, DoorDash, Postmates, Grubhub. In West Palm Beach, we have about 17 other local ones. And here's the problem. It's all a flawed model. We all want food delivered, but the way these things work doesn't really work. It's not great for the restaurant. All of these companies lose money. That's why they're all talking about things like, well, what if I also picked up your dry cleaning or, got you some groceries along the way? So this is one of those things where it's very tricky because we all want food delivered. And right now we need food delivered. So we might be willing to pay a little more for it right now. But in a normal day, when you're going, okay, should I just drive out for 10 minutes and get the food or should I pay somebody else? Well, are you going to pay them $4.99? Maybe. Are you going to pay them $4.99 plus everything in your order is marked up 15%? You might not be willing to do that. Are you going to pay them even more than that? I looked at getting Starbucks delivered this morning, and it would have cost me like an extra coffee. And that's, of course, because I'm taping things all day. I'm kind of tied to my desk. I don't have the ability to leave. The closest coffee place is maybe 5 or 6 miles away where I am right now. This is something that I think we're going to see. We're going to see more of these companies merge with each other. We're going to see changes. We're also going to see, hopefully, maybe an end to companies, DoorDash, Uber Eats, Grubhub. They all put restaurants on the platform where the restaurants aren't actually a partner. Well, why is that a problem? Menus don't update. So you might order something that's out of stock. You might miss out on a special. You don't have the ability usually to make a custom order. So, hey, I love that dish, but geez, I'm allergic to peanuts. Could you leave the peanuts off? Not allowed to do that. So I think there's a lot wrong with this space, and it's really become something that the pandemic has sort of masked the flaws. Everybody is using these things. I know for New Year's, we were considering where to order from. And at one point, a place we wanted to go was pickup only. And, that to me might as well have been like, well, you have to like wrestle an alligator before you get it. Because the idea of going downtown on New Year's to pick up dinner just didn't seem like fun. Whereas like pre-pandemic, we would have done that in a heartbeat. So the world is really changing. But I wouldn't get too attached to any of this because I don't think it's going to look like what it looks like. What's that going to mean? You might have to join in order to use some of these services and pay them some sort of base fee. They all offer that as an upsell, but it's not a requirement. It might move to more fully like Instacart, where I mentioned before, where you pay extra for every item you order. There's not enough money here for the restaurants. There's not enough money here for the delivery companies. Something has to give, and I do think that will happen post-pandemic.
Well, Dan, during the pandemic, I think my wife and I tried Grubhub, and eventually, as you know, we changed over to more vegetarian, more fruits, vegetables, making things at home. I'm still kind of old-fashioned, though. If I want to go out to get sushi or have it, I kind of walk down the street, or I get in my car. It's a 5-minute drive. Does this contribute to maybe some of the other things? I understand the benefit. I mean, if you're taping all day, when you were saying that, I thought you maybe need a production assistant, or maybe you convert your son into that. But in all seriousness, I mean, does this make us, what's the point of always ordering in if you can go out? Is it some laziness? What does this mean for overall health?
Well, right,
How do you measure all these, the calories you're consuming?
right now, Jeff, I think it's the pandemic. I mean,
Right.
but before the pandemic, there are places I never would have even considered having, delivered. I would just go pick it up. That even right now, again, I go out, I've eaten in restaurants, but only ones that are being safe. I don't particularly want to be out in downtown West Palm Beach where the restaurants are being safe, but the people aren't.
That's true. That's true.
And it's not even the people in the restaurants necessarily. It's the people that are just milling about. So it's one of those things where right now, literally, my wife and I ordered a few nights ago from a restaurant I can't quite literally see from my bedroom window, but if there wasn't stuff in between me and the restaurant, I'd absolutely be able to see it. It's less than a half mile away. That being said, it's less than a half mile away across a 6-lane road that I'm perfectly happy to cross during the day. I don't really want to cross at night. So, yeah, I do think we need to be conscious of the fact that it's easier to get unhealthy food via delivery. And to compound that by you're getting unhealthy food and you're not even like parking and walking to go get it, you got to think about that. On the other hand, Jeff, I had sushi delivered last night, which I'll consider a good choice.
That's a
Um,
very good choice, I think.
Certainly it was a healthy order, and that maybe wouldn't have been the choice I would have made, if I didn't have so many things at my disposal. Probably would have been a lot easier to get a pizza in the pre-Grubhub era. So there's pluses and minuses, but you've got to be conscious. I mean, we're doing a podcast. I'm holding up my watch. I'm wearing the Apple Watch, and I can't tell you how many times at like 8 o'clock at night I've had to go take a 20-minute walk, to complete my rings. I think we all need to be conscious of that, especially in the pandemic where maybe we're just moving less than we used to. Not so much by intention, but we used to park in a parking lot and walk to the office, and at lunchtime you go get a cup of coffee or whatever it is. We're not doing those things now. I know I'm going to be sitting in this chair from 10 a.m. until 1 p.m. I'm going to make a real effort after that to go take a walk or go do something a little bit physically active.
Yeah. Well, I want to shift gears, and I'm looking down at my cat who's in the studio with me, and if I say the word EAT, he will go crazy and ask for it. So let's shift gears. Let's talk about retailers bracing for the flood of returns from online shopping. So, Dan, overall, was it a good year for retailers? Maybe the big box stores did well in this crazy time, but overall, how did retailers do?
So overall shopping numbers are going to be up, according to early predictions from the National Retail Federation, but it's going to be very skewed. Your Amazon, Walmart, Target, Best Buy, maybe Lowe's, maybe Home Depot, probably Dick's Sporting Goods. And that might be just about it in terms of big retailers. Now, there are others. Marshalls and TJ Maxx probably did fine. But a lot of your struggling retailers, your Macy's, your Dillard's, your J.C. Penney's, certainly your Sears, which might have had a chance of doing well during a traditional holiday season just because of sort of like overflow. Even when people go to the mall right now, and I've been to the mall, it's crowded. I mean, it's maybe not Christmas crowded, but it doesn't feel empty in any way. But I do think your adult shoppers are there with more purpose. I went to the mall. My son wanted sneakers. We bought sneakers. He had, some lunch in the food court, and then we left. It's not like our typical meandering around the mall. That's going to hurt all of these. It doesn't matter what they put into Macy's, how their merchandise evolved. They didn't have a good season. I can almost assure you of that. I think the biggest failing is, so one of the issues here is there's going to be a massive flood of returns. And that tells you everything you need to know about how retailers are doing things wrong. Now, obviously, there are sometimes returns because of, ill-purchased gifts. I send Jeff an ugly Hanukkah sweater, and he goes, I don't need to wear a sweater. I live in fairly warm climate. And he sends it back and buys a wetsuit so he can go surfing. That is an acceptable return.
Yeah.
A lot of returns are stores just don't have the right stuff and they don't have customer service. And I think this is being lost, in the whole digital era. I ran a retail store. As you know, I ran a giant toy store for a couple of years. And people would always ask me, oh, it's January. You worried about a ton of returns? I said, we're going to get less than 10 returns. We averaged about 4 returns for Christmas season per year. And that's because when someone came in, I talked with them about who they were buying a gift for, what that person might want. Often I knew the people because there was a lot of hands-on, customer service there. And everyone in our store could do that. So you're matching people to things they want. Well, that doesn't happen. If I go on Amazon, I might just go to electronic gifts for male coworkers, and all of a sudden Jeff is getting like a clock that does something funny that he doesn't want. Like that's a big failing in this online world, but it is something that we've talked about. Companies are evolving to deal with it. Walmart, you can now return packages like just from your house, just put it back outside and call them, and they'll or email them or however you communicate, and they'll do it. Amazon, you can return them at Whole Foods, you can return them at Kohl's. You're going to see more of this, but I would also like to see them fix the process where there's just more one-on-one, more help, more, even if it's AI driven, there shouldn't be a lot of returns. You should be able to get it right the first time. I think that's something really good brick and mortar retail does. It's not something the internet does very well. So it's going to be really good news for UPS and FedEx and the U.S. Postal Service for the next few months.
Yeah, it sounds like it. Well, good news and a lot of mixed news. I mean, I certainly think that, as long as we're talking about big box companies, the Amazons, the Walmarts, the Marshalls, etc. Dan, I still worry about the smaller businesses. I mean, they have been very hit hard, even though at the time of this recording we do have COVID relief. Still, they're struggling, and
yeah,
the only thing. Go ahead.
It's going to be devastating. There are companies that just aren't going to come back that were, look, a lot of businesses are barely operating even when they're run really, really well. Your average mom and pop, might be throwing off a slight profit and everything is managed really carefully. Well, how do you handle an unexpected, 50% drop in sales? And sure, some of those businesses were able to pivot, but I think of my old toy store. They operated, with curbside and with pickup, during the beginning of the pandemic. They know their customers really well, and a lot of their sales are recurring sales for collectibles and other collectible games and that type of thing. But a big percentage of the sales is also just someone wanders around the store and they find something they want and they end up leaving with a $400 helicopter they never planned to buy. All of those sales are gone, and they're open with some capacity at the moment, but a lot of the normal rhythm for these small businesses just isn't happening. And look, if you own, say, a small clothing boutique, that's a really hard business anyway. Who's buying clothes? Certainly nobody needs to buy a bottom. We're all doing Zoom meetings. And that's actually true. Walmart has talked about how they're selling way more tops than bottoms, which to me feels like short-sighted because at some point the pandemic's going to end.
You're going to need pants.
You can't go to work with like a dress shirt and shorts. Like that's not going to work. But yeah, look, if you can shop small businesses, if you can support a local restaurant, to tie this into the first part of the show, support a local restaurant and even your chain restaurants, support the people who work there because, it might be a chain, but the waiter, the general manager, those are all people from your community.
Yeah, absolutely. But Dan, great to chat with you as always. Happy New Year again to you and your family. And look, we look forward to having you back on for your first tech appearance of 2021. Have a great rest of the weekend. We'll talk to you again then.
We'll talk about robots taking over in 2021. That's my first. No, I'm kidding.
Such a tease. Such a tease.
I am kidding, Jeff. I'll see you next year.
All right, buddy.
Welcome back, and now we're going to talk markets. Joining us on the line, he's the co-founder of Delphi Digital. Welcome to the show, Kevin Kelly. Kevin, Happy New Year to you. Thanks for joining us on the program this morning.
Happy New Year to you too, Jeff. Thanks for having me.
We appreciate having you on and getting your insight into both markets, and I should have said as well, cryptocurrency. So let's, maybe we'll use this time to maybe look backwards a little bit. When you reflect back on 2020 and markets and the economy, what's top of mind for you and the team at Delphi?
Yeah, I mean, it's tough to ignore where markets wound up or ended up at the end of the year. And to be completely frank, I did not expect us in the S&P to be trading at 70 or 3,700, 3,800. I did not expect us to be coming back or recovering that strongly, I guess you could say. And there's a number of reasons for that. If you look back again, hindsight being 2020, you had obviously massive monetary stimulus this year. I think one of the key themes of 2020, and that's going to transfer into 2021, is going to be this idea that fiscal policy is now really going to have to take the wheel and sit in the driver's seat to continue to try and bring back this economic recovery. I do think, though, that there are a number of trends that were in place before, we'll call it the pre-COVID days, that were only exacerbated by everything that happened in the aftermath of the pandemic, and one of which, and the big one, is that K-shaped recovery we've talked about, where you have kind of two different recoveries going on. One at the top end, we'll call it not necessarily the top 1%, but basically all those who have assets or have or invested in the markets. Obviously, markets, as I mentioned, came roaring back. I think the S&P is probably going to end the year up around 14 or 15%. The NASDAQ, which is really, you're kind of weighted much more heavily towards your big tech stocks, that's going to be up. I think it's 44 or 45% year to date if we closed out right now. So again, compared to where we were back in March, it's crazy to think that those March lows might actually be the lows for this cycle, because I don't know the quick math at the top of my head, but I think it's a bit of like a 51 or 52% correction that we need to see in the NASDAQ to actually retrace back down to those March levels, right? Which would be a huge, huge move. So, this whole year, I would say in the summer months, I was pretty skeptical around this rally and thought that it might be a bit of a bear rally, just because there was so much deterioration going on in the kind of broader macroeconomic landscape. Now it seems like, again, we're going to come out of this, but I guess the big question in 2021 and beyond is, what are the big kind of structural changes that are going to happen to the economy, and how are we going to deal with this, again, accelerated bifurcation between, the haves and the have-nots?
Yeah. Well, I was going to bring that up because, yes, I think the market has recovered, but when you look at the economy, certainly there are millions of people that are unemployed. They may have had some of their unemployment benefits disrupted because of the debate. Any sense, Kevin, and I don't want you to put on we'll wait for prognostication maybe next week on next week's show, but when you think about kind of getting those people back to work, and I know you're not necessarily a public policy person, but how do you think about employment? What does employment look like, and for people that are maybe have to reskill or maybe relocate? I mean, what's that look like?
Yeah, I think there's definitely a number of different factors to pick apart there. One, the latter point that you mentioned, the relocation. There's definitely, I sit in New York City, and I know firsthand, at least a dozen to 24 people who have permanently moved out of the city into either suburbs or have gone, places like out west in Denver or other places where, as you start to understand how to work remotely, how to kind of get into a routine, how to get into a process, which again, we've been doing this for, the better part of 9 months now. Yeah. I do think that the way in which people work, the future of work and the future of employment is going to be very, very much dictated by where that person wants to work and the ability for that person to kind of work and do whatever they want, right? So when it comes to something like, think about like residential real estate markets, it's really interesting to see where prices are falling versus where prices are rising right now. And a lot of places around, I'm again from upstate New York, lake houses upstate, Finger Lakes, like that area has really, really taken off. Whereas, you've seen some prices in the city areas or the metropolitan areas come down, right? So I think that, number one, is going to be a very interesting trend to continue to watch. I think it's going to be something that's more secular, and it's not going to be necessarily, everybody coming back into these cities in 2021. The future of employment, and again, this kind of ties into the crypto digital asset argument, but in a much longer time frame. But I'll say, in the short to medium term, I think what's interesting is the opportunities. It's tough to think about how hard this year was, but the silver lining is that you always have opportunities that really kind of arise from these recessionary periods, right? Where you get things like concepts like creative destruction, where, so far we haven't seen these signs of capitulation, and there are a lot of companies out there that have maybe gotten funding or have gone to the capital markets to raise, more capital that maybe arguably investors shouldn't be putting their money into. But at the same time, these recessionary periods, long story short, tend to have some type of creative destruction element to them. And I think that definitely paves the way for potentially a stronger recovery as we look out, 2022, 2023, as you get some of these excesses that we're building up. As some of those start to come out of the market. Now, there's still a lot of those, and I certainly think we have a long way to go. But I think, again, the silver lining here is that you just have I think, a structural shift in the way in which people are working, and the opportunities that are going to arise from this and that are already starting to arise in this more kind of digital or emerging internet economy. I think that's going to be longer term, a really big benefit for people.
Yeah, let's hope, because I think a lot of people got whipsawed at the lower end of the pay scale. So let's hope that they bounce back. Kevin, let's turn our attention to crypto, because you wear two hats because of your previous experience. Let's talk about Bitcoin. Just reading some things this morning, Bitcoin touches 29,000, which is another record high, and that's just one of many cryptocurrencies out there. What's your thoughts on crypto this year? Or this past year, I should say.
Yes, yeah. So it was another one of those, in hindsight, I didn't necessarily think that Bitcoin would break or get this close to 30K by year end. To be honest, we were really hoping just to see it break above its previous all-time high of 20,000, which, we saw at the end of November. So it was obviously towards the latter end of the year. But Bitcoin, if markets closed right now at this exact moment, I think Bitcoin would be up about 295% year to date, which is an incredible return, obviously. But it kind of sits. I'm actually writing this piece right now. It sits as king of the hill yet again. If you look back at 2019, yes, there was a lot of price volatility, but we saw something similar in terms of Bitcoin kind of leading the pack in terms of major asset classes and major assets that are investable. And so what I think 2020 has done, especially the last really several weeks, it's put Bitcoin on the radar, on everybody's radar for 2021, right? And that's all the way from your corporate treasurers to your, I won't necessarily say pension funds, because I think they'll be a little bit later, a little more conservative, but your RIAs, your wealth management industry, your global macro funds, everybody is at least looking at it or is aware of it. And I think what's going to shift is it no longer suffices to just say, we're dismissing Bitcoin, it's a scam and has no intrinsic value. Those arguments don't really hold very much weight anymore, especially with anybody who's an informed investor about, Bitcoin in this space. And so I think the arguments are going to become more sophisticated against Bitcoin, which is great because that encourages, stronger discourse. But it's also, I think, just the fact that it's in the conversation and that these different investor types have to have some type of view on it, right? Whether they're bullish or bearish or whether they want to put it in their portfolio or not put it in their portfolio. I'm not saying that either is necessarily right or wrong. I just think the process, the investor kind of methodology or process around understanding it and having an informed opinion about it is going to be a big kind of trend in 2021, even if you see some of these funds not necessarily kind of commit to a small allocation of Bitcoin. So again, long story short, just it being part of the conversation, I think, is a huge point to be made for 2021 that I think we're going to continue to see accelerate.
Kevin, as Bitcoin has grown, there has also become more scrutiny, or come with it, as was typical scrutiny. And recently, the Department of the Treasury Department of the Treasury, proposed some new financial crimes enforcement network regulation. At least it's proposed. Any thoughts on the crypto regulatory environment? How that's evolved over 2020? Because with any time an asset class becomes really serious in the minds of investors, not only accredited investors, but also retail, general lay retail investors, that's when the regulatory and legislative action typically jumps in. Any thoughts about some of these rules that are being considered, because they're not final, they're being considered, and what the framework has looked like in 2020?
Yeah, I mean, it's definitely, as I mentioned, it's getting more sophisticated, right? The arguments against, Bitcoin and crypto assets from a regulatory standpoint, it's becoming more sophisticated. Regulation is kind of a double-edged sword. I sit in the camp that I certainly think it's beneficial and long-term we need it. If you want to see institutional capital come into this market, you have to have more regulatory parameters kind of set in place, right? What I also think is that with the Stable Act and some of these recent regulatory proposals that have come out, they certainly could, in the short term, potentially, hinder prices and hinder adoption. But I think regulators are almost kind of targeting the wrong, I guess you could say the wrong kind of access points. And that's what makes crypto and digital assets very unique, is that it is a bit complex in terms of the ways in which you can get around some of these regulatory potential hurdles that are coming down the pike. And I don't necessarily condone, obviously, hiding or stashing away money, but there's ways in which people can get around some of these. And I long story short, I don't think what regulators proposed, I think they thought it was going to have a bigger impact than it has so far, right? Again, we're in the very early innings, but I think just by and large, if you look at just the sentiment around what they've done, there are people coming out and saying, okay, this is interesting, and this certainly can be somewhat effective. But I do think that regulators are going to say that they haven't gone far enough, and I think they're going to find that out in 2021, and that's going to be where you see some really big kind of tension points between, the crypto community and regulators. Is, what is proper and fair regulation, especially in a global market that trades 24/7, 365. The U.S. right now sits in a very kind of precarious position because you don't want to stifle innovation. You don't want to encourage people to go elsewhere, which we're already starting to see because of the regulatory environment. But at the same time, you need to put some type of fence around, what's going on within the crypto and digital asset space. And so I think 2021 is going to be a big year for regulation, but also for regulators to understand, I think at a deeper level, what's really going on in the crypto and digital asset market.
Thanks, Kevin. And last question, I'm sorry for keeping you long, but it's hard not to pick your brain. Blockchain in 2020, looking back at blockchain, just the technology that it's the undergirds crypto and could be applied to other markets. How do you think that has performed, and maybe some of the advances in 2020 that give you hope for other markets?
Yeah, I think when you think about just blockchain more broadly, right? And we've split this into kind of private blockchains and public blockchains.
Mm-hmm.
Private being your kind of more enterprise. There's certainly advances taking place, and there's progress to be made on the enterprise side. But to be honest with you, I don't think that I think people expected 2020 to be more of a kind of enterprise type year, or you'd see more enterprise adoption. And at least from this where I'm sitting, we haven't seen a ton of that yet. It certainly can come in things like security tokens and tokenizing assets. That's been a theme for a lot of people for a number of years now. But I do think as you get in 2021 and asset allocators look for differentiated opportunities, I think private markets and private securities are going to play a big role in 2021 in putting those or tokenizing those in some way, shape, or form. Public blockchains, though, I think are really, I mean, when you're talking about the innovation and really kind of the next, I guess, generation of this internet economy, I mean, that's where I think a lot of the progress is going to be made, and then that'll kind of transfer over into some of the enterprise solutions. So.
Yeah, it's amazing, and look, I could talk to you for hours on this. I'm going to let you go. Enjoy the rest of your weekend. Have a great. I'm so glad it's 2021. We flipped the page, and look forward to having you back on the network next week. Take care, my friend.
Sounds great. Thanks for having me, Jeff. Have a great new year.
You too. Bye-bye. Welcome back. Now we're going to talk real estate. Joining us on the line is Jacob Passy. He is the real estate reporter for Market Watch. Jacob, Happy New Year to you and your family. Thanks for joining us this morning.
Happy New Year to you as well.
Thank you, sir. Great to. It's 2020 has obviously been a very difficult year, but I think we're all looking forward to 2021. Jacob, we really had some great conversations in 2020 about mortgage rates being at their lowest, the lack of a housing for in certain areas in the country, migration. But, as we're kind of beginning the new year, what's top of mind for you and the folks at Market Watch when it comes to real estate?
Yeah, so, I mean, I think mortgage rates are always top of mind. They closed out 2020 hovering just above a record low. So they set another record low right before Christmas on Christmas Eve, according to the weekly report from Freddie Mac. And then this week they stayed right about there. So right now the 30-year fixed-rate mortgage is averaging 2.67%, which is wow, an absurd rate. I mean, earlier this year I spoke with the CEO of now Rocket Holdings, but then the CEO of Quicken Loans. And, he had said at that time that he didn't expect them to drop below 3%. And that was, back in March, right as the pandemic was starting to kind of come into the rearview mirror. So hindsight's 2020. Obviously, the pandemic has been a major influence on mortgage rates, but it's interesting to see how low they've dropped. And the story I did on this also looked to where they're going to go in the new year.
So you can't tease us, Jacob. You've got to. I'm going to ask you as a follow-up. So where do we go from here in 2021? New year, new calendar. Uh, do rates start to creep up a little bit? Maybe?
Yeah, well, that's the general thought among economists. So obviously, with the disclaimer that forecasts are
Accurate.
hardly ever accurate, and more often than not, especially in real estate, economists get things a little bit wrong, and I don't think anyone could have predicted a global pandemic like there was in 2020. And the pandemic is a bit of a wild card, right? So right now, the vaccine's starting to be rolled out nationwide, although we're not necessarily hitting the targets that we set for ourselves. I think, Fauci on Thursday, gave an interview with the Today Show, kind of saying that he's disappointed at how slow kind of the rollout's been. But the vaccine is rolling out. I mean, we can kind of see the end coming towards us for this pandemic, and what will happen with mortgage rates will largely depend on how quickly things resolve with the pandemic and what that means for the economy. If we see a bounce back in employment, manufacturing, et cetera, that will lift the economy, and in tandem, so will rates go up. Most economists are projecting rates to go up a slight amount, not a huge amount. I think the highest anyone's kind of predicted is around like 3.2% average for the year. So still ridiculously low by historical standards, although that's over half a percentage point where we are now. But a lot of economists are predicting 3% as the average for 2021. So staying kind of in this ballpark, but maybe going up a bit. But of course, even if mortgage rates go up a slight amount, that could be a major issue for a lot of households looking to buy homes. You and I have talked a lot about how home prices are skyrocketing because of the shortage of available homes nationwide. And so that's expected to continue next year. And if mortgage rates do go up as well, it's going to make affordability a challenge.
And that's certainly not a good thing, especially if you're trying to get into a home for a first time, or if you're moving out of a city, you want to start a family, you want to buy a home, it could be very difficult. Where are we, Jacob, just I guess last question, where are we with kind of building up the inventory? I know when we've talked over the last year, inventory kind of depressed. We don't really have the inventory for people who want homes. Is any improvement there in terms of housing starts, new developments, regulatory regulations kind of being lifted in some areas?
Yeah. So home construction is still, keeping up pretty steady pace.
Mm-hmm.
I think, in recent months it's hit, kind of recent highs, 10-year highs or so. And I think that pace is going to continue. The biggest issue with home building is, there's capacity limits. There's only so many skilled laborers nationwide who can, construct homes. There's only so much supply of lumber to go around. There are only so many available lots to be purchased to build homes on. And what we're working with basically right now is kind of a historical backlog. After the Great Recession, there was a significant period of time where home building activity, because of the housing bubble that burst, was really depressed. I mean, a lot of home builders were building on spec before the housing bubble burst. They were building, I grew up in Florida. I lived in Florida at that time. And, you could go pretty much anywhere and find, an empty, gated community that had been completely built out, but no one had purchased yet. And that was the case across much of the country. And so a lot of home builders were spending many years not building very many new homes and just basically working through their kind of backlog of homes they'd already built on spec but had not yet sold yet. So that put us, kind of at a disadvantage for now because, in all that time, it wasn't as if, the population stopped growing or anything like that. The population kept growing. People kept getting married, having kids, et cetera. And so a lot of those folks, were sitting on the sidelines for many years and are now jumping into the market, especially millennials. So, all of this is to say that, home builders are working their hardest, I think, and they're, all the fundamentals are certainly there to keep home building activity elevated. But the problem is going to be that it was so depressed for so long that it's going to just take a lot to really get us to where we need to be.
Jacob, I lied with the last question. Let me ask you about lending. So mortgage rates are coming down. We don't know if they're going to tick up from 2020. What about the 2021? Excuse me. What about the scrutiny by which lenders are lenders going to still be scrutinizing your W-2s, your tax returns, your assets? I mean, is that still going to continue for the foreseeable future in the 2021?
I think a lot of that will depend on, the economic recovery. So right now, there are still hundreds of thousands, millions really, of households nationwide that are in forbearance on their mortgages. And, that number has trended downward since, this summer, and hasn't really crept upward at all, which is good. But there are still millions of people that are basically skipping their monthly mortgage payments. And, starting, in March, those people will kind of reach the end of the mortgage forbearance that they were afforded by the CARES Act. So they will then, at that point, have to sit down with their lender or their servicer, really, sit down with their servicer and work out how they're going to handle their mortgage payments moving forward. A lot of folks will modify their home loans and get into a more affordable mortgage product for them, whether that's, extending the term of the loan to make up for those missed payments or, adjusting the rate, things like that. But there are going to be a lot of people who are still, falling back, still don't have any, backup options. They may still be unemployed. They might still be in financial trouble. And we don't know what's going to happen to those people yet. I think I think a lot of folks will say on the one hand, the good news about the world we're in right now is that, because home prices have been elevated as much as they have been, folks in this position might be able to just, cut and run. They might be able to sell their home and, not go into foreclosure. But that's supposing that they'll find somewhere they can afford to rent or anything like that.
Right.
And, a lot of folks won't be able to do that. And so it remains to be seen whether we're going to see a large wave of foreclosures or anything like that, or folks falling delinquent outside of forbearance in the new year. And, if that comes to fruition, I certainly would expect mortgage lending to remain very tight, by which I mean, lenders are going to be very picky about who they lend to, especially when it comes to refinances. I think there's going to be a bit more scrutiny with those. A lot of folks, we talked about refinances in the context of rates going down, and certainly that was driving a lot of the activity. But a lot of folks, while at the same time they were taking advantage of lower rates, were cashing out some equity. And so, if those folks fall into a hard position, let's say, the economy, goes back down again in the new year, then we're in a position where those folks might have less equity to fall back on in terms of their mortgage and things like that. So lots of different kind of machinations here, but I think that, mortgage lending is going to probably remain somewhat tighter than it had been in recent years for the foreseeable future until, lenders can kind of get a sense of the state of the economy and where it's going to go.
Well, Jacob, it's always a pleasure chatting with you. Really appreciate the expert analysis as always. And look, we look forward to having you back on again in 2021. Have a great rest of the weekend, and we'll talk to you again very soon.
Yeah, take care.
Welcome back, and time to check in now with David Levine and Kevin Walsh. Both are known as the Legal Eagles. They're both principals with Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks for joining us this morning, and Happy New Year to both of you.
Happy New Year, Jeff. It's great to be here, and hopefully 2021 is a more, positive and enjoyable year for all as compared to 2020.
Well, I think all of our fingers are crossed. Kevin, let's start with you. And we're going to use this show to take a look back at some of the top developments of 2020 in yours and David's mind. So kick us off. What's top of mind for you?
Well, thanks, Jeff, and Happy New Year, listeners. It's always good to be here. For me, kind of the big story of 2020. Well, other than novel coronavirus, other than the election, other than the George Floyd situation. The big story for me in the benefit space was just the wave of guidance that we got in 2020, and looking at DOL, looking at the Trump administration's Labor Department, and looking at years 2017, 2018, and 2019, we may have thought that 2020 would be another kind of relatively slow year for guidance, but it wasn't. It was a bit of a deluge. We got guidance on things ranging from considerations for including private equity inside a default investment option in a defined contribution plan, to guidance related to proxy voting, to guidance related to the types of factors that plan fiduciaries should take into account when making investment decisions. So when is it appropriate to take into account that global warming is a problem? And then at the end of the year, we got this last little push of guidance where we got a burst of guidance in the form of a new exemption from the Labor Department that typically we've had to go when we analyze whether an investment's allowed or whether someone who is helping give investment advice can get compensation. We've had to kind of go through all these wonky little one-off exemptions. At the end of the year, the Department of Labor provided a broad exemption that can be used for everything ranging from commission sales to asset-based advice, and it harmonizes somewhat with the SEC's regulation best interest by imposing a best interest standard of care. So looking back at 2020, it's been a very busy Labor Department. We've gotten lots of guidance. I think next week when we talk about what's likely to happen in 2021, we might revisit some of this. But for me, the story of 2020 in the benefit space has been just the volume of guidance that we've gotten that relates to what plan fiduciaries are supposed to do when making investment decisions. David, do you want to highlight something else from 2020?
Sure, I've got a couple things. First, 2020 was a year that picked up on 2019. We got the Secure Act finally at the end of 2019, and we got a bunch of legislation, a lot of it in response to the pandemic. We had Families First law, we had the CARES Act, we've had the legislation right at the end of 2020 as well that made a lot of retirement changes, everything from distributions to paid family leave to dealing with headcount reductions and required vesting and partial plan termination that came out right at the end of this year. A lot of this was designed to help people bridge through this challenging period of time we are going through. And that was a lot of legislation. It was, in a sense, more benefits legislation crammed into a year than ever. I was saddened that, Kevin, you didn't mention the missing participant guidance was missing, but I'll keep going from there. The IRS continued to do things, and pooled employer plans kept moving forward, and we're going to start seeing more on that soon. To me, one thing that's big, though, to mention in the land of benefits is litigation. Litigation kept rolling along. We saw a massive amount of suits, close to 100 lawsuits filed involving 401k plans and fees of all kinds this year. That's a lot. A couple firms were responsible for driving a lot of it. But you also saw, on a positive note, some wins for the defense side. And you're seeing the defense bar actually stand up and fight. There have been a lot of cases where you've had not only the wins, but where the defense bar doesn't just settle immediately. And I think that's a good thing, because as lawyers, yes, do we benefit from litigation? Absolutely, in terms of economics. And is the litigation ever going to go away completely? No. But at the same time, to see if we could get balance, I'll say balance in the universe, because everything seems to revolve around litigation when you talk to people these days. Hopefully we'll start to see some more finer points and lines drawn as we head into 2021. Maybe that's a little bit of hope, but we can talk about that next week as we look forward.
Yeah. And David, I've got a question for you. With PEPs going live this week, are we finally at the planning point for picking a pooled plan provider?
It is really a picadillo about providing a PEP to the perfect participants here? And so that's a really good question, Kevin. The answer is we'll see. Perhaps.
Well, David, Kevin, in all seriousness, I thank you very much for all your contributions this past year in 2020. Look forward to your prognostications and look forward into what we might expect for 2021. Wishing both you and your families a happy and healthy new year, and we look forward to having you back on the program next week for your look forward.
Thank you so much, Jeff.
Thank you, Jeff, and happy New Year to you, and happy New Year to all your listeners.
Thanks, guys. Take care. Be safe. Bye-bye. Well, that wraps up this episode of BRN Sunday. I want to thank all of our great contributors for making time, especially during the holidays. Don't forget, we're back again tomorrow for BRN AM. I'll be joined by Christopher Moore. He's the founder, CEO, and president of Zeroed In. We're going to be talking about HR analytics and what does it mean for you as an employee. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.